Hello, everybody, and welcome to Hash Rate. My name is Mark Jeffrey. My guest today is Mikey Milken of VESTA Finance. But first, a shout out to crypto exchange MEXC. Join using my link in the YouTube show notes and get up to $4,100 bonus. MEXC has the widest selection of coins at 1,533 pairs. MEXC, I love it. I use it myself. Join today and use our sign-up code. So on to you, Mikey. Hello, welcome to the show.
Hello, Mark, and thank you for inviting me here.
My pleasure. So Mikey's going to leave his camera off because he is a pseudonymous founder. So in the spirit of that, we're going to allow him to have the camera off. So don't expect to see him. And there's nothing wrong with your screen. So Mikey, tell me, what is Vesta?
Yeah, sure. Thanks for this is a very intro question to start with. I think to start talking about Vesta on a very high level, Vesta is a stablecoin protocol where you over collateralize other crypto assets to produce our stablecoin called VST, which stands for Vesta Stable. At the time of Vesta's starting, the infamous Terra USD hasn't failed yet, and we were taking some inspiration from that, trying to grow just like Terra. So yeah, that's a quick summary of what it is.
So it strikes me as being very similar to MIM and Abracadabra, which is a protocol I'm familiar with. I used it. I still use it. And in that protocol, basically there's 30 yield-bearing assets that can be used as collateral. You have to show up with roughly 1.5x in collateral of whatever you want to borrow. So if you want to borrow $100, you have to show up with $150 worth of another one of these yield-bearing assets. And then you get the stablecoin MIM, which you can then use in DeFi or trade it for another stable or whatever. And the system actually works. It has worked amazingly well. So first of all, is that a fair comparison to say that you're sort of like MIM?
I think so. I think if anything, Vesta system is better than MIM. So, but fundamentally, that's exactly right. We work on a over collateralized model similar to MIM, MakerDAO, Liquity. Yeah, very different from say algorithmic stablecoin like Bases, Terra USD. Very very different.
Yeah, because Terra was famously not backed. I mean, some people say it was backed by Luna, but it's you're backing yourself with yourself. So
That's right.
so not really backed, and at least back yourself with somebody else's thing. So yeah, so kind of not collateralized. You are in fact collateralized. I will say this though, for the sort of the MIM, the design that you use, which is similar to MIM. I know you're a fork of Liquity, but in my just how it works in my mind, it's sort of a MIM-ish thing. But what I will say for the design that you share in common, after Sifu Gate, which is kind of what pulled MIM off of its pedestal, where Sifu basically, I won't get into what Sifu Gate is, but basically there was one of the founders which was proven to have been a felon, and even though he didn't do anything wrong with that particular protocol, it sort of infected it. So at that moment, Luna's Do Kwon had a curve pool with a whole bunch of Terra in it against MIM. And when the Sifu Gate thing went down, in an effort to sort of dissociate himself from MIM, Do pulled all the liquidity of Terra out of Curve, leaving a giant amount of MIM against kind of nothing in Terra, and that should have caused a depeg event on the MIM side and possibly killed MIM. And I was watching this very carefully because to me this was the ultimate destruction test. And MIM sort of dipped down to about 97 cents per MIM, and at one point it was at 93 cents, but it always popped right back up to $1. So in my mind, this design has survived a massive destruction test. Agree? Don't agree? What do you think about that?
Yeah, I fully agree with that. When I think how a lot of people make the distinction here is whether the assets are exogenous to the system or not. So if you look at Terra, obviously the collateralization ratio is also an issue, but Terra effectively, the collateral was not exogenous to the system. They were, they were backing with their own governance token, versus MIM and Vesta. The collateral are exogenous to the system. They're not within Vesta's control, and we structure each collateral system very, very carefully to ensure that we're not being exposed to too much risk. We evaluate each asset very carefully. So um, given that this is the design, the overall risk is much lower. If anything, I would say the overall risk is close to zero. Um, but that is for everybody to decide.
Sure, of course. Yeah, I mean, I would think that with the whole MIM thing, I was actually shocked it survived. I got to be honest. So, but MIM, MIM base, I think it survived because it had 30, and I don't know if it's exactly 30, but roughly 30, as you say, exogenous, so something outside of the MIM system, coins that are not in Abracadabra's control, that were backing it. So that if any one of those backing coins fell apart, there were 29 others left. So that sucks that you lost that one, but it's over collateralized. It's 1.5x whatever the amount of MIM that's outstanding out there. So if one of the bits of collateral goes down, it should not kill the system as long as you don't have too much in that 1/130th bucket, right? Which is how you're being careful, I assume.
Yeah, that's exactly right. So the one of the parameters when we onboard a new collateral is mint cap. Effectively, we evaluate a certain collateral. Well, first of all, we need to, go over all the kind of fundamental analysis of what it is, and looking at whether it's safe or not. And then at a certain point, we assign a min cap to each of these assets, just to make sure that you know, VST as a whole isn't being backed too much by a certain asset. So, as an example, right now we have Ether set at 30 million. Um, Ether, technically speaking, is one of the safest assets across the whole ecosystem, because you can trade it everywhere. There's a lot of bridging support. You could bridge it back to mainnet, all kinds of different networks. You can, even go in and out of centralized exchanges very easily from Arbitrum, um, using Ether. So there's just a lot of places where you can trade it. So the liquidity is very fluid. So it makes it the most sound collateral a stablecoin could have. Um, on the other hand, we have just added GLP. GLP, on the other hand, isn't um, isn't traded per se. It's more of a redeemable asset. So, when you have something like that, you have to control the risk. And GLP
Let's
also
define.
is
I just want to stop you there. So GLP, for
true.
people who don't know, so there's a new exchange called GMX, I believe, and GLP is a token, which is I think sort of like 3 curve, where it's like Ethereum. It's like a couple of tokens like Bitcoin, Ethereum, like a bunch of blue chips. Am I right about that?
That's correct, yeah. So, um, effectively, GMX, what they use is a virtual AMM, so virtual automated market maker, where um, GLP is effectively a liquidity pool token, and people who are trading on top of GLP are effectively utilizing the liquidity that are provided by people who deposit into GLP. Um, yeah, and that's how if you go to the GMX website, you'll see that GLP earns a pretty hefty yield of sometimes 20-30%. It's all because of how people, it's it's actually because of that the system is trading and accruing fee to the GLP holders. Yeah.
Got it.
Yeah.
So one thing I read on your website in relation to that, so it says get 120% APY on GLP in a Vesta vault. So if GLP is natively getting 20 or 30%, how are you getting 120%? How does that work?
Yeah, so 120% is actually no longer the case in the sense that it's actually higher now,
Wow. Okay.
theoretically. Yeah, because what happened was we structure the collateralization ratio at 120%. Translating that to loan to value, it's roughly 80%. So if you are depositing $1 worth of collateral and loan to val is it loan to value? Yeah, the LTV. I'll just say that. If the LTV is 80%, then you're able to take out at 80%, then you're able to take out 80 cents of loan if you put in $1. So
Ah,
yeah, so with that, what some people will choose to do is they will take that 80 cents and they will buy the asset again to take
got it.
out.
So you're looping. You're basically looping it. So
That's right.
borrow, loop it. So it's sort of nested, I don't know, 4 or 5 times deep until it sort of doesn't make sense anymore.
That's
And
correct.
okay, got it. And then on top of that, it's I assume that 20%, 20 or 30% it's earning in GLP. That's all transaction fees coming from GMX.
That's correct. I believe so.
Okay.
Transaction fee as well as, um, yeah, yeah.
Okay.
I'm not going to
So
pretend I know the asset very, very well. So,
yeah, I totally get it. That's fine. You're not here to
yeah,
talk about GLP. Totally understood. So yeah, okay. All right. So the looping thing, I know some people listening to this because I have some people outside of crypto who are watching this. You and I are more used to that because we've watched other protocols do that. Isn't that doesn't that create like a big giant danger of a cascading liquidation?
it does. Um, it really depends on the underlying assets, right? If you look at GLP, you can redeem it for stablecoin, you can redeem it for Ether, both of which are very, very liquid assets. So I think last I checked, I'm not. This has been it's been a couple days, I think, but last I
Yep.
checked, you could redeem up to 100 million worth of USDC using. Say that you have 100 million worth of GLP, you could redeem it for 100 million worth of USDC. So USDC, I would say it's even better than ETH when it comes to
Sure.
actually when it comes to liquidity, because there's always going to be people willing to buy it back up to $1. The redeemability for actual dollars in the bank is very well known, and people are willing to take the risk to do a time-based arbitrage, hold it, buy it at, say, 99.5 cents, and then arbit right back to $1 to get that yield. So you know, when you have an asset that's so redeemable, for underlying assets that are extremely liquid, uh, it's not really going to cause a liquidation cascade in the sense similar to what happened to Geom. Sorry, what happened to Ohm. Yeah,
Right. Or Terra, where it's
yeah,
just one
yeah.
thing. Yeah. So yeah. So basically, the idea is that if there is a liquidation, it shouldn't start a cascade where because the liquidation causes the price to go down, which then causes more liquidations. Because there's so much liquidity, the price should more or less remain the same. That's the theory, right?
Yes, that's correct.
Okay. Okay. Um, so it also says that you guys. So I know you said your design is better than MIM. I think in one way it's better is your loans. MIM basically charges interest for all of their loans. You have zero interest loans, correct?
Mm-hmm.
And so, how do you make money?
So there is mint fee for people who generate loan using Vesta.
Yep.
So it's effectively, origination fee. Um, we also take a cut on yield assets. So if you look at GLP, if you look at GMX, both of these assets could be staked right into GMX, and then there's a yield coming out of it. Um, this is, I would say, a model that is which makes it better compared to Abracadabra, Maker, Liquity, all of those people. In this is that we mobilize the underlying collateral to somewhere that is able to generate yield, given that the staking opportunity is is good enough, effectively, and we then take a cut out of out of that staking opportunity. So, beside origination fee, that's another place where Vesta actually earns revenue.
Got it. So the treasury itself is earning yield,
That's
as well as the origination fee. Okay, got it. So that's how you're able to offer zero interest loans. So you have chosen to launch on Arbitrum. Why Arbitrum? Why did you make that choice?
Arbitrum. At the time that we chose this ecosystem, this was back in, I would say, October last year, really. Um, I personally am a huge fan of Ed Felton, who is the professor at Princeton University, who is the co-founder of Off-Chain Labs, which created Arbitrum. Um, I took his courses and all that stuff, so had a personal connection here. And then at the same time, I tried out a bunch of different ecosystems, Polygon, different layer ones, right? Like side chains, like um, Polygon, Avalanche, and all that. And then also tried out Optimism um, and layer twos. And at the time, it was very clear that the user experience of using Arbitrum is much superior compared to all of these other ecosystems. The Due to how Arbitrum utilizes something called a sequencer, um, it effectively allows sub 1 second confirmation. Well, not full confirmation, but on the user experience side, it is basically a confirmation where you would confirm a transaction on Vesta or GMX or whatever Arbitrum ecosystem project, and if you click on the transaction or Arbiscan transaction link immediately, you'll realize that the block explorer shows that your transaction has confirmed immediately,
Wow.
and that to me was kind of the deal sealer, I would say. It was just a such a the user experience is superior by a mile compared to anything else. Um, so I mean, obviously, Arbitrum still has its issues, right? Like it's not sometimes, for example, um, sometimes it would overload. Right before a upgrade a couple days ago, um, it was Arbitrum had a network kind of migration upgrade. It was called Nitro, but before Nitro, Arbitrum held a network-wide contest called Odyssey, and it, a lot of people were trying to game the system. A lot of people were trying to Sybil attack, not attack, I guess, but Sybil, Sybil for
Oh, Sybil attack. Got it. Yep.
that's right. Civil attack kind of for airdrop and all that stuff, and it really overloaded the system. Um, and it's I would say that when it comes to um, taking in a lot of transactions is not yet as capable as mainnet. This recent upgrade to Nitro has actually already resolved a lot of that already, but um, there is definitely still some shortcoming and stuff. But in the current stage of crypto, it is by far the best user experience. And those issues, they will not pop up 99.9999999% of the time.
Got it. So
Yeah.
it feels a lot like, so your thesis is, I remember when I first tried Phantom and Solana, I had that feeling of, oh my god, this is like Google fast.
Hmm.
And Arbitrum, from what you're telling me, is actually even faster.
That's correct.
So those other things are sort of around a second, which felt miraculous compared to Ethereum. And this, if it really is sub-second, that truly is Google speed.
Yeah.
So yeah, so that's super cool. Um, so tell me a little bit about the state of Vesta. Like how much stablecoin is out there right now?
That's a great question. Let's pull up
Well,
the
just roughly. It
stats.
doesn't have to be exact.
Yeah, so we have 10.7 million Vesta stable out there circulating. The protocol currently has close to $26 million locked in the well, 26 million dollars worth of collateral locked in Vesta.
Yep.
We've seen, I believe, close to $100 million of volume uh, on VST, the stablecoin,
Yep.
and yeah, it's one of the most highly traded Arbitrum stablecoin actually. If you don't count USDC, if you don't count um, USDT, VST is actually, I would say, literally the most highly traded um,
On
stablecoin
Arbitrum.
on
Yeah.
Arbitrum. Yeah, so there's
Well, you
that.
guys, you guys seem to be pretty tight with FRAX, and I noticed that I think the major sort of trading pair that you have on Curve on Arbitrum is the VST FRAX Curve pool, which has about $10 million total in it, of which 70% is VST and 30% is FRAX, and you're seeing about a quarter million a day in volume. That was what I saw last time I checked. So correct?
Yeah, yeah.
Agreed. Okay.
So, FRAX, we've we have a very deep partnership with them. They were very instrumental in helping bootstrap the early liquidity of Vesta. Um, yeah, so that's why we have a pool with them. To kind of go further on talking about liquidity pool, we are exploring setting up multiple more liquidity pools, I guess you can say, to provide easier user experience. We're thinking of pairing with ETH, thinking of pairing with USDC, using a variety of decentralized exchanges such as Uniswap V3, Balancer, all that good stuff, just to um, give a even better user experience. I think currently the trading user experience of going in and out of VST isn't that optimal, so we're looking to improve that in the short term.
Okay. So now let's talk a little bit about Ohm. So I noticed that Geom is by far the most used collateral in your system. So the vault that you guys have set up, I think you have 4 or 5 different coins you currently accept as collateral, and Geom is one of them. And the other coins are sort of a quarter full, a half full of their quotas. Geom is totally full. So, tell me why you decided to accept Geom, and why do you think it's so full? Like, why do you think that was so popular?
Yeah, Geom, or Olympus as a whole actually was one of, again, also a launch partner of ours. Um, they effectively provided incubation support pre-launch and as well as post-launch. And one of the premise that we went off of is that Olympus is, it has a very, very fat treasury. And if you
Yeah, it's 300 million. For those of you who don't know, that's the actual number. I checked last night. That's how I know. So yeah, huge treasury. A lot of people are like, "Oh, Ohm died. Ohm's gone. It failed." But not really. It's still very much alive and has, and as you say, massive war chest.
That's exactly right. Yeah. So one of the framework that people have came up with um, to analyze Olympus as well as Ohm forks is a phrase called net asset value, where people draw kind of a comparison between um, the treasury's total value to how much each token would be worth if the treasury were to be fully distributed to each token. So the net asset value, excuse me, the net asset value of Ohm is basically 300 mil, right? So, distributing that to each token, um, effectively it creates a price floor for the asset. And if you look at, Olympus's own website, you'll see that they actually put that number right on the website. So, and the price of Ohm actually fluctuates around that in the recent months. So it's if anything, I think this particular theory works very well. And
Yeah,
so, therefore, for something like Vesta, where we collateralize and produce loan based on this particular asset, that's actually a really good asset to have. Where the treasury is there, the governance is there. It's not going to rug, hopefully, and
right.
then you have all these. Um, you basically have a backing to this particular asset, so it makes it um, an ideal collateral to have for creating a stablecoin.
Yeah. So the theory is, for just to restate it. So so you're in the business of giving out loans to people who show up with good currency, good crypto of one form or another. Ohm is one of the better cryptos because, unlike a lot of coins that tend to range up and down in value a lot, they have huge volatility because nothing backs them. It's just whatever the market says. Ohm is backed by $300 million worth of assets and at the bottom of the market. So it's pretty much at the floor of where it's going to go. And you know that each Geom is worth a percentage of that 300 million, whatever the number of Geom coins are out there outstanding, you're 1,008th or whatever it is of that 300 million. You can rely on that Ohm is redeemable for that. So therefore it makes it a very good asset for you to lend against. And on top of that, you're 1.5x collateralizing it, so it's even safer. So pretty good, right?
That's exactly right.
Okay. So right now, you guys, I just want to point this out. This is not investment advice, just to be really clear. You guys have a market cap right now of about 5 million, which is sort of angel investor levels, right? So kind of a really good. If you believe in this and you think it's good, that's kind of a very low price. I can tell you, I think Spell. I actually didn't look before the show, but I'm relatively certain Abracadabra. It was definitely above 1 billion at its peak. I think it went up to about Spell, the coin actually for Abracadabra, went up to 3 billion at its height. So if you think this has that kind of potential, again, this is not investment advice. Um, it would seem to be a good. It would seem to be a good bet. Bottom line. So, um, okay, now to ask a question from the peanut gallery. So I went on Twitter and said, we were going to be speaking, and I asked some folks to submit some questions. One of them came in, and so I'll read you the question right now. Vesta is a Liquity fork, and they initially said they were going to allocate 2% of the VSTA supply to LQTY, that's Liquity coin stakers. However, the allocation of LQTY stakers is no longer in Vesta's tokenomics documentation. Why is that?
First of all, shout out to this guy for asking this question, whoever you are. So I'll kind of give a long answer here. From a project's perspective, one of the most important thing that you have to manage is I, you know, managing selling pressure, right? So if you just give 2 million tokens to some people who probably have never learned about the project and probably do not bother to learn about the project and learn about how, even though we started out as a fork of Liquity, how much implementation differences we now have compared to Liquity, um, they they're just gonna see it as free money and then dump it on the market, impacting current token holders. Um, that's why we have slowly shifted away from just giving free tokens to liquidity holders. However, it is not out of the question, I would say. Um, so I did mention earlier that we are pushing out new liquidity pools. So those new liquidity pools are actually going to be incentivized by a brand new staking program where we are actually going to give out rewards in a more escrow fashion. So it's going to be vested. You will have certain restrictions, such as you cannot sell your original stake when you are vesting your newly earned rewards and so on and so forth. So all these mechanisms are there to throttle selling pressure on the token, right? So these are effectively ways to, you know, as we kind of branch out to get more partners into the Vesta ecosystem, we have to like give out new tokens and stuff like that. So we're gonna utilize this brand new incentive structure, brand new staking program to conduct that. And once that's there, we're giving rewards to the Liquidity ecosystem partners is not out of the question through using that particular staking program. But it's just that, at the start, we were thinking, okay, we do want to acknowledge the Liquidity team, the Liquidity community, and so on and so forth through airdrop. But over time, we realized, okay, airdrop is quite possibly the worst type of uh, the worst type of the worst way to give away tokens, right? Like you're just gonna give it away for free, and people are just gonna
Dump.
yeah, exactly. They take it to they go on the CoinGecko, they look for the liquidity pool, and they press sell immediately. So, you know, I mean that's fine if you're just a hype project hoping to be here for 6 months. Probably not even, right? Like during the bull market, you can probably pull that off in 3 months. But for Vesta, we're hoping to be here for 5, 10, 15, 20 years, or even 100 years, if that's if all is well. So we're not gonna just let mercenary people come in here and be like, hey, free money, liquidity pool providers, here it is. I'm gonna wreck your token now.
Right.
So,
Okay.
yeah,
So that's the answer. Is basically the liquidity folks. That your intent is to get around to them at some point, but for right now, just handing out free tokens for them to get dumped on the market, that just hurts everybody. So you're not going to do that. Bottom
that's
line.
exactly right. Yeah.
Yeah. I mean, that's a reasonable answer. So, okay. Next question. So, recently the United States announced plans for a stablecoin bill, which I'm sure you guys are paying attention to, just like all of us.
Hmm.
And I looked at I looked at Jason, I think it's Cherevosky, is how you pronounce it, who's a big lawyer guy on Twitter who kind of analyzes all this crypto stuff. And his analysis basically said it looks like, and again, this is all just sort of early, so we don't necessarily know that these are all the things that will be in the final bill. It's just what we think we know right now, best information we have. It looks like stable coins will be required to have backing of liquid assets, and it appears that the crypto assets, like what you guys do, are okay. And for those who are for those stable coins that actually aren't backed in that way, that are algorithmic purely, um, uh, those coins would have a 2-year grace period in order to somehow get backed. Have you guys been studying this? Is that your understanding? And how do you think this affects you, if at all?
I have. monitor the situation not closely, but definitely, looking at it from time to time, as it's definitely could impact the future of the project. I think one of the things that I noticed was liquid assets. They were mostly referring to traditional finance assets. Um, but some people have different takes, right? Like for example, this lawyer that you followed, he's probably including crypto assets such as Ether, on-chain USDC, stuff like that, as part of the liquid assets category as well. I mean, that would be ideal. That
Yeah,
that
we
would
all
be
agree that would be
yeah,
ideal. Yeah.
that would be ideal for Vesta after all. But um, I think the approach that I, in my mind, I am formulating is we want to respect the law. We the laws are there for a reason. May sometimes it may be a bit too old school and all that stuff, but I believe this new law is created to protect consumer finance. So we want to make sure that we have we're pissing the least amount of people off, and
Sure.
if it is certain that this particular model that we're operating on is going to be cracked down, then a pivot is not out of the question. You After all, we're a business, right? We want to make sure we have token holders, we have equity holders to serve, and after all, the what matters is that the business is running and it is a valid business. Um, Obviously, we don't want to go through that because currently the business model is working just fine. Um, so yeah, that's kind of my take on it.
Yeah, understood. Okay, well, we're coming up on the end of our time together. So, is there anything I should have asked that I didn't that you'd like to bring up?
I think that covers most of it, Mark.
Oh,
Really appreciate all the insightful questions, and thank you for representing the people of Twitter in asking the two big ones. Um, yeah, well,
where can we find you on Twitter and what's your website? So we have that.
so people can find us at vestafinance.xyz. That's our official website. You'll be able to access Twitter, Discord, all that good stuff from within their website. Or if you don't want to go through that and go straight to Twitter, our handle is Vesta Finance, no space, no dash.
Got it.
Yeah, there it is.
Okay, Mikey. Well, we are now at the end. Thank you so much for taking the time to come on the show and explain everything. My name is Mark Jeffrey. This has been Hash Rate. We'll see you next time.
See you guys next time.
Okay.